Hello, this is the Chartprofit video. About an hour into the trading session on Friday 22nd of April. This from the pre-open today. We're looking at the E-mini S&P. Very recently the first level support moved up here to 2075.50. All the value areas this week have been printed above that level. So in the short term, that strong price location, we're above the more important support down here at 2041. So again, in the longer term, still in a good price location here. Just dipped a little bit on Thursday. It did mark aggressive selling here for the first time in 15 days. As I explained in the pre-open, this is aggressive selling on the day frame. In the slightly longer frame, it's just reactive. Wasn't particularly effective selling. The value area here is overlapping the other value areas this week, and as I mentioned, it's all above that first level support. So this just could be normal corrective activity again. The buyers who have been pretty active, as you can see the green on the chart, just resting, allowing the sellers to make an appearance just to find out how effective they can be. So far this isn't effective selling on any time frame, but I did say even so I want to see significant buying. That's green marked again before initiating new long trades. Selling marked down here, red marked here below 2075.50 would be more important than the first sign of weakness. Sentiment, I made quite a deal here of the Ridex ratio. Basically, first 3 days of this week the market advanced and the ratio fell as the market advanced, which is pretty healthy short-term sign. Yesterday the market fell and the ratio went up. Nothing too much to worry about, but this bit here, I do not want to see more of that pattern. It would suggest that the Ridex traders are buying the dip, and that's not usually a healthy sign. 3-month high for the ratio itself. We're looking at the chart here. My version of the Ridex assets ratio, the 3-month high recorded last week. In the longer time frame, you can see that the ratio is still quite low, indicating that the retail trader are nowhere near as bullish as they were back here, back here. My only slight concern would be if the market continues to come lower and the Ridex ratio here spikes up above that level. Again, that would be more of a sign they're buying the dip, and that may be a little worrying. You can see how low the bull fund assets got at the recent low, and it's quite an interesting chart. Just looking at the bull fund assets in isolation, when they fall below this level, it tends to be where these low in the markets come in and the market starts to rally. And the point I've been making over the last few weeks is this has not really rallied very much at all. So there's a real skepticism on the part of the retail trader to sort of a hated rally, really. And from a contrarian perspective, that's usually a good sign. The other side of the coin is the bear fund assets in isolation. They're getting down here towards the lowest they've been this year. And if we saw the ratio, if we saw the bear fund assets fall a little more, take us to a new low for a year, that wouldn't be alarming, but something to watch out for. If we look back here at the low, well, that is the low point all the way back to August last year, and if we see the assets fall down to here, that would probably coincide with the ratio moving higher as the bull fund assets most likely increase at the same time, and then we'd maybe have something to be concerned about. Public poll from AAII this week reported that the bulls percentage was higher at 33.4%, bears was slightly lower, 23.9%. If we look at the 4-week moving average of net that I keep going here in black, it's this level here that would indicate, if we exceed that level, would indicate maybe over enthusiasm. And something to start looking at. But you can see we've had a terrific rally. I think that's about 14-15% from the February low, and like the Ridex ratio, this is fairly slow to get up to an elevated level. In the investors intelligence poll, we did see quite a bit more enthusiasm this week. You can see the bulls percentage is higher at 47.4. That's the highest bulls percentage since July last year, and the bears percent was lower this week at 21.7. That's the lowest since August last year. Gives us a net figure here, this histogram on the right, the bar there, that's the highest since August last year. I think more importantly I watched the 4-week moving average in black, and that has just very slightly peaked above the previous peak back in November. Mildly concerning. We've also seen the exposure index this week. It's a measure of current equity exposure of active money managers. It's actually spiked up to 82.5. That's the highest since May last year. Not a very good indicator for calling tops, I would hasten to add. Much better on the lows, as we've seen many times, but just to note that is moving higher. It's now the highest since May last year. But I see no sign of, again, the retail trader here in the Lipper US fund flows. Nothing here to be too concerned about. The market has pushed on. The 4-week flow in black here. There's money flowing into equity funds, including ETFs. Still pretty low. We had an outflow this week of 4.5 billion in the week to the 20th, and the 4-week flow, as I said, it actually turned lower and is in negative territory. Wouldn't be anything about this indicator, this chart, that would suggest that the market is about to fall. That's more likely to happen when we see this 4-week flow peaking above a previous peak to a higher level and then falling below zero. What we do have, and I have mentioned this, is quite an overbought situation. This bottom indicator shows us the percentage stocks in my list of New York stocks that are trading above their 50-day moving average, and for this entire period here we've been above 80, so we're still in that overbought condition. This indicator here has just moved above positive 20. That's the what I call net volume percent 10-day moving average. That's getting to a high level. So we are overbought here. What does that actually mean? Well, the concern comes, for me anyway, for these two bottom indicators fall below certain levels. So percentage net new highs 25, 5-day moving average here in black, when that falls below zero, and the percentage stocks that we just talked about when that falls below a 50% on average. And what we would get then is this indicator in the middle here, the breadth indicator, turning red. Now currently this is still green. That's good, especially when the momentum at the bottom here is above zero. That would be green as well. That's good. At the moment we're actually heading up. Two concerns on this chart are this. Number one, this indicator is showing severe divergence. Okay, we're rallying back up, but this momentum indicator has been heading down, which gives us a negative divergence with the price action. Number two, the major level here, I'm actually showing the spider, is this level up here. This is the major. Okay, and we've just tested into that and had a little bit of red marked on the E-mini. So that's the concern. I would be much happier if we see price up here. We just have to monitor in the short term what happens over the next few days. If we do see a reaction from that level, does it turn into something serious? Okay, here's the current chart. Here's that major level I just spoke about. Market has come a long way up, and we have tested that major level. So at the moment this is quite an important junction. We should focus on that. If we see price, as I mentioned, above that level, that would tell us something serious about the market, not least in just simple chartist point of views. We're kind of overcoming this previous resistance up here. Looking at IWM, Russell 2000 ETF, actually outperforming the spider today. We're higher, I think. The major is up here, 115.35. So as we've been talking about, this is an important level. Again, price above there would suggest a further leg up and a really powerful market. This could be quite important resistance, I think, here. We have overcome the halfway point, which was the other major level we were watching. We had resistance here. We dipped a little bit and then came back. That's a good sign. Don't want to see price back under here now. I prefer those two charts when watching for major levels, but we're looking here at the diamonds. The 2-year point of control is at 176.50 in here, and we're actually above that in a strong location. So on this chart, if we see something like that, even we dip down to that level, be a little bit of a correction, but still be in a strong price location. Looking now at the FTSE 100, the UK FTSE 100 has moved above its 12-month at 61.39. We had that strong pattern of a higher low on its major down here at 58.70, consolidation, and then moved higher. We're now just above the halfway point, and actually today we've retraced to that point. So a really good pattern would be this. Who knows? By the close today or early next week, we may see price down here, which will put it in a weaker position. We've still got that support down here, but there is some weakness today, at least at the end of the week. I think the FTSE 100 today, relatively one of the weakest indices. certainly stronger than the German DAX. If you look closely, you can see that the current daily bar up towards the high of the week, we have this resistance a little higher on the halfway point, which, as we know, can be a really powerful resistance. Price above there would suggest another leg. We've seen quite a powerful move once the DAX made its first higher low off the low and then back above that major, and we've seen a really strong move here. Adding anything to anything related to this index, I'd prefer to see price up here, as I mentioned. Looking here at bonds, this is IEF, the 7 to 10 ETF. The level at 110.38, we added a bit more time here earlier in the week, at which point it became slightly more important at 6 months rather than 4 months, and seen price sharply lower from there. And obviously if we saw this turn around and turn back up, then that would be resistance. Price above it would be good, but currently this is weak price location. And TLT, the Treasury Bond ETF, 130.78 in here. We've seen the 6 month migrate to that level, and we are below there in a weak price location, but we have in the longer term this halfway point off the high last year to the low, and you'd expect support there, at least temporary support if we see it. Right now you need to see price back above 130.78 to say it's strong location. Quick look here at gold, the gold shares ETF, TLT, currently in a strong price location above 118.22. Is a slight movement in the major to that level, very slight. Hopefully that will be big support for this chart. We saw recently, earlier in the month, that we dipped down to what was the previous point of control, just above 115, and we rallied from there. And if we see this level hold now, if we see price even consolidating above here, that puts this chart in a strong position. You don't want to be fading this move at the moment, at least. I would say you'd wait for this support to break before you thought about that. It would be quite a way down before we did it, but this at the moment looks like a strong chart. Oil has got to be a positive for equities at the moment. We've been highly correlated for quite a long time. Just to review, coming up off this low, we had a reasonably important 6 month at 9.1 in here. Then we retraced the first up move back down to that level exactly, which was very close to what was the halfway point at that time. And then we're pushing out to the highest level this year. Because the decline was so rapid over here, there's very little in here in terms of resistance levels that we can kind of gauge off. So unfortunately it's maybe watching short-term technicals, because the closest level I have of any importance is down here. So anyway, breaking out to a new high is usually a positive. And a chart here, the dollar index, kind of closely related in a way. Okay, the 2 year has migrated lower to 94.79. That's this red line here. This is quite an important event, I think, worth noting. So 94.79 on the dollar index, we've seen a migration of this important level. We know that often happens before a directional move, and currently at the end of this week we're printing above that level. If we see time here and consolidation price above that level, rather than a swift rejection, price back here pretty quickly would be quite negative and suggest we break that. But if we can hold above here, that suggests there's some strength coming into this very oversold index. And if we start to see strength coming in for the dollar, that could derail the move in oil and possibly equities as well. So important chart. And a clue to that is the Euro FX chart, which is a high component of the index. Now here we've got important support, the 3 year at 111.98, and below that the halfway point of this year's low. So price in here would definitely be confirmation of strength in the dollar. There may start to be a problem here and there. This area of price though should be important support. The pound, surprising to some, is showing some strength over the last few days, and not so much against the dollar, simply because we're seeing strength in the dollar as well. But we are printing above the 8 month, which is at 142.60, and in the short term, if we remain above that level and that point of control does not migrate, this chart won't look weak to me until it falls back below here. Okay, I'll leave you this chart. This is an intraday chart, or rather an hourly of the E-mini S&P. We have our first level support at 20.7550. That's the blue line, and we've reached that level about an hour and a half into the trading day. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.